DraftKings just launched an app that could unlock a $1 trillion market, and Wall Street noticed immediately. DKNG stock is already moving. Analysts are upgrading. And early investors are asking one simple question. Is this the catalyst that sends DraftKings 35% higher, or even more, in 2026? Let's break it down. Imagine this for a moment. You're not betting on a game. You're not spinning a roulette wheel. Instead, you're trading real-world outcomes. Will the S&P 500 finish higher this month? Will inflation come in hotter than expected? Will a blockbuster movie smash opening weekend records? And you're doing it inside a fully regulated app, backed by one of the biggest names in online betting. Here's the key detail most people are missing. This isn't a startup experiment. This is DraftKings. And as of December 19th, 2025, they officially launched something that could reshape their entire business model. It's called DraftKings Predictions. Today, we're breaking down why this launch matters, why analysts see 30 to 35% upside by 2026, and why smart investors are paying very close attention to DKNG right now. Welcome back to Simpson Foresight, the channel where we cut through noise, focus on real catalysts, and turn complex market shifts into clear insights that help you build long-term wealth. I'm Mr. Simpson, and today we're diving deep into DraftKings Inc., ticker DKNG. Educational content only. Always do your own research. Let's start with the market reaction, because timing matters. As of December 20th, 2025, DraftKings is trading around $34.50 to $34.70, up roughly 1 to 1.5% following the Predictions app launch. The stock closed near $34.19 yesterday and pushed higher in early trading today. Market capitalization sits around $16 to $17 billion. Now zoom out for a second. DraftKings has been volatile this year, pulling back from prior highs, but something important has quietly changed beneath the surface. DraftKings is now consistently a bit day positive. That's a major shift. For years, the bear case was simple. Great growth, but no profits. That narrative is breaking. User growth remains strong. Sports betting and iGaming revenue continue to climb. Operating leverage is finally kicking in as marketing efficiency improves. This is no longer a burn cash forever story. So why does this new app matter so much? Because DraftKings just entered an entirely new market, one that goes far beyond traditional sports betting. Introducing DraftKings Predictions. On December 19th, 2025, DraftKings officially launched DraftKings Predictions, a standalone mobile app and web platform. This platform allows users to trade yes or no contracts on real-world outcomes. Let's be clear about something important. This is not traditional gambling. DraftKings Predictions is regulated under the Commodity Futures Trading Commission, the same regulatory framework that oversees futures and derivatives markets in the United States. That distinction is critical. Why? Because it allows DraftKings to legally operate in 38 U.S. states, including massive population centers where sports betting is still restricted, such as California, Texas, Florida, and Georgia. Think about what that means for growth. DraftKings just expanded its total addressable market without waiting years for gambling legislation to change. Right now, users can trade contracts tied to sports-related outcomes, financial and economic indicators. And management has already confirmed plans to expand into entertainment, cultural events, broader real-world outcomes. This is not a side feature. This is not a beta test. This is a strategic platform. Expansion. Why prediction markets are exploding. Prediction markets sit at the intersection of four powerful forces: trading, data, behavioral psychology, entertainment. They appeal to people who enjoy markets, probabilities, and decision-making, not just sports fans. And the growth projections are massive. According to industry analysts like Eilers and Krejcik, the prediction market space could reach up to $1 trillion in annual trading volume by 2030. That's not marketing hype, that's structural demand. Platforms like Kalshi and Polymarket have already proven strong user adoption and engagement, with multi-billion-dollar valuations. But DraftKings brings something those platforms don't: scale. DraftKings already has tens of millions of registered users, powerful brand recognition in the US, best-in-class marketing execution, mature risk, compliance, and fraud systems. They also acquired Railbird Technologies, giving them exchange-level infrastructure to eventually control and optimize their own prediction marketplace. At launch, liquidity is supported through CME Group integration, reducing early execution risk. Over time, DraftKings plans to transition more functionality in-house. That's disciplined execution. Lower risk now, more control later. What Wall Street is saying: analyst reaction has been clearly bullish. Mizuho reiterated an outperform rating on DraftKings with a $46 price target, implying roughly 34% upside from current levels. They described DraftKings predictions as a market share protector, a new customer acquisition engine, a diversified revenue driver beyond sports betting. Overall, analyst sentiment remains strong buy. Across more than 30 Wall Street analysts, average price targets cluster between $45 and $47, representing 30 to 35% upside. The most bullish projections? As high as $63, implying 80% plus upside if adoption accelerates and execution exceeds expectations. Why this could materially change DraftKings economics. This launch checks several strategic boxes at once. First, new users, new states. Prediction markets allow DraftKings to reach users in states where sports betting is still illegal. That alone dramatically expands TAM. Second, revenue diversification. This platform attracts traders, finance-minded users, and higher frequency engagement, often with better margins. Third, lower customer acquisition costs. DraftKings can cross-sell predictions to existing users instead of spending heavily on new marketing. Fourth, platform leverage. More products mean more engagement, higher lifetime value, and stronger ecosystem lock-in. Some analysts believe this platform could add hundreds of millions of dollars in incremental revenue over time, without cannibalizing the core sportsbook. That's meaningful. Risks, because no real investment thesis is complete without them. Regulatory scrutiny remains a real factor. The line between trading and gambling will continue to be debated. Competition is intensifying. FanDuel is exploring similar products. Kalshi and Polymarket are scaling aggressively. Execution risk exists, especially in early liquidity building. And DKNG remains a volatile stock that can swing sharply on earnings or macro news. That's why diversification matters. Position sizing matters. Patience matters. This is not a short-term flip. It's a thematic growth opportunity. The big picture. When you zoom out, a real product just launched, not a concept, a $1 trillion market opportunity. Improving profitability trends. Strong analyst. Conviction, stock still well below long-term targets. DraftKings is no longer just a sports betting company. It's positioning itself as a regulated marketplace for real-world outcomes. And moments like this, when a new platform launches before the revenue fully shows up, are often where long-term opportunities begin. If this breakdown helps sharpen your edge, hit like, subscribe, and turn on notifications for more high-conviction market insights. Drop a comment below. Are you buying DKNG here? What's your 2026 price target? Stay informed, stay disciplined, stay ahead. Disclaimer: this content is for educational purposes only and does not constitute financial advice. Markets involve risk. Always conduct your own due diligence